1929 was the worst time in American history to be rich because the same market that had turned ordinary people into millionaires was about to tear fortunes apart in a matter of days. And you didn't have to be a Wall Street tycoon to get caught in it. You could have a good job, a comfortable house, a little money saved up, and a few shares of stock sitting in your account. For years, those shares had seemed like the smartest thing you'd ever bought. They kept going up, so you bought more. Then they went up again. Your neighbor was making money. Your co-workers were making money. Newspapers were filled with stories of people getting rich in the stock market, and every new price record made the last one seem almost insignificant. America had entered the roaring 20s, and for millions of people, the future looked almost impossible to lose. But there was a problem hiding underneath all that prosperity. A lot of the money being made didn't really exist yet, and a lot of the people getting rich were getting there with money they had borrowed. To understand how America reached that point, you have to go back to a time when the country seemed to have discovered the secret to endless prosperity. The 1920s were unlike anything most Americans had experienced before. Factories were producing goods at a remarkable pace. Cars were becoming common. Radios were bringing news and entertainment into people's homes. New products were appearing everywhere, and businesses were growing rapidly. For many Americans, life genuinely was getting better, and Wall Street reflected that optimism. The Dow Jones Industrial Average had been around 63 in 1921. By September 1929, it had climbed to roughly 381. That's about a six-fold increase in less than a decade. Imagine watching your investments multiply like that year after year. At some point, the question stops being, should I buy stocks? It becomes, why wouldn't I? And Wall Street had an answer that made the decision even easier. You didn't necessarily need enough money to buy the stocks yourself. You could borrow it. This was called buying on margin. Suppose you had $1,000. Instead of buying $1,000 worth of stock, you could put up your $1,000 as a down payment and borrow the rest. Now you're controlling $10,000 worth of stock with only $1,000 of your own money. If that stock rises by 10%, your $10,000 becomes $11,000. You've made $1,000 on an investment that originally cost you only $1,000 of your own money. That's an incredible return. And as long as prices kept rising, leverage made people feel like geniuses. But there was another side to the deal. If the stock fell sharply, the debt didn't disappear with it. Your broker could demand more money from you. And if you couldn't provide it, your stock could be sold whether you wanted to sell or not. The system worked beautifully when prices went up. It became vicious when they went down. But in 1929, very few people were thinking about the second part. They were looking at the first. Everyone had a story. Someone's cousin had doubled his money. A businessman had made a fortune in the market. A clerk who had never considered himself wealthy was suddenly talking about buying another house. The stock market wasn't just something happening on Wall Street anymore. It had become part of everyday conversation. And that matters because bubbles don't usually survive simply because people are greedy. They survive because people have evidence that their optimism has been rewarded. If you bought stocks last year, you made money. If you bought them 6 months ago, you made money. If you bought them last week, you might already be making money. After enough success, caution starts to feel irrational. Why sit on the sidelines while everyone else gets richer? So people kept buying, and prices kept climbing, until the market began showing signs that something underneath the surface was not quite as healthy as it looked. By the late summer of 1929, the economy was already losing some momentum. Industrial production had begun weakening, and cracks were appearing beneath the excitement. But the stock market was still near its peak. That created a dangerous gap between what people believed and what the economy was actually doing. Then, in September, the market became increasingly unstable. Prices swung sharply. Confidence started to weaken. But most investors still weren't prepared for what came next. Because after years of watching stocks rise, a serious crash was almost impossible to imagine. Then October arrived. On October 24th, 1929, selling exploded. It became known as Black Thursday. Investors rushed to sell their shares, and the panic became so severe that major bankers gathered to try to stabilize the market and restore confidence. For a moment, it appeared to work. The market recovered somewhat, and that probably made the next few days even more dangerous. Because if you were an investor watching from the sidelines, you might have thought the crisis was over. It wasn't. On October 28th, Black Monday, the Dow plunged nearly 13%. The next day was Black Tuesday. More than 16 million shares changed hands as investors desperately tried to get out. The ticker tape couldn't keep up with the avalanche of trades. Prices collapsed. And suddenly, The strategy that had made people rich became the reason they were trapped. Remember that $10,000 investment you bought with $1,000 of your own money? If the value crashes, you don't simply lose the money you invested. You can owe money on an asset that's rapidly becoming worth less and less. So you sell. But when millions of people are trying to do the same thing at once, everyone is running toward the same exit, and the exit gets smaller. The market crash was devastating. But here's where the story gets misunderstood. The stock market crash did not, by itself, instantly create the entire Great Depression. The economy was already weakening, and what followed was much more complicated and much more destructive. The real nightmare was what happened when the financial panic spread beyond Wall Street. Banks began coming under pressure. People became afraid that their banks might fail, so they rushed to withdraw their money. And banks couldn't simply produce everyone's deposits on demand. They had invested and lent out much of that money. When too many customers wanted their cash at the same time, even a bank that looked healthy could become vulnerable. Then businesses started cutting production. Factories reduced their workforce. Workers lost jobs. People who had lost income spent less. Businesses earned less. More workers were laid off, and the cycle fed itself. This was no longer just a story about investors losing money on stocks. It was becoming a story about ordinary Americans losing jobs, savings, homes, and any sense that the economy was still under control. And this is where being rich became especially cruel, because wealth was supposed to protect you. You were supposed to have options. You were supposed to be safer than everyone else. But imagine being wealthy in 1929 and watching the things you trusted begin failing one after another. Your stocks are falling. Your business is losing customers. The bank where you kept your savings may not survive. The people who worked for you are losing their jobs. The companies you invested in are struggling, and the entire economy is moving in the wrong direction. You could still own a beautiful house and a car. You could still wear an expensive suit. But if the financial system around you was breaking apart, the appearance of wealth didn't mean much, and the numbers eventually became almost impossible to comprehend. The Dow, which had reached about 381 in September 1929, eventually fell to around 41 by July 1932. Roughly 89% of its value had disappeared, and it would take more than 2 decades for the Dow to finally recover its previous peak. But even that number doesn't tell the whole story, because a stock market chart doesn't show the person who lost a lifetime of savings. It doesn't show the factory worker walking home after being laid off. It doesn't show the family standing outside a bank that is closed. It doesn't show the business owner who suddenly can't make payroll. And it doesn't show the psychological damage of watching a future you thought was secure slowly disappear. That's what makes 1929 so interesting. The people caught in the crash weren't necessarily reckless gamblers who knew they were taking an enormous risk. Many were ordinary people responding to what looked like an extraordinary opportunity. The market had been rewarding optimism for years. Their friends were getting rich. Their neighbors were getting rich. The newspapers were celebrating the boom. And every new high made the possibility of another high seem more believable, until eventually the belief became stronger than the evidence. That's the dangerous part of a financial boom. It doesn't need everyone to be stupid. It only needs enough people to believe that tomorrow will look like yesterday. And for a while, it did, until it didn't. The crash of 1929 became one of the defining financial disasters in American history, and the economic collapse that followed would reshape the country for years. But perhaps the strangest thing about the story is that from inside the boom, the future probably didn't look terrifying at all. It looked prosperous. It looked modern. It looked unstoppable. If you had been standing on Wall Street in the summer of 1929, with money in your pocket and stocks climbing almost every day, would you have seen the danger coming? Or would you have looked at everyone getting richer around you and thought the same thing millions of other people thought? That this time, the good times were going to last.